This doesn't have to be something that you took or something that you even seen in real time, but something that you could at least go back to always review what you're trying to find for price to go up, even if you were not playing it from the long side, but something to say, this is the scenario. This is the sequence you want to see. First off, you had longs come in and then go away. Secondly, you had shorts come in and they didn't go away. Let's play it. And I'll show you what I mean. Just look at this vertical. See the longs that come in right there and then go away? That green that popped in and come away. Generally, when price goes up, you don't want a lot of people long if you're long, because it's hard for price to go up if a lot of people are long. If a lot of people are long, a lot of people are trying to sell it above the market, and then it makes it harder for it to go up. So it's too much competition. Now, when you get a sample size of some longs coming in and then scratching it, so that's that green popping out and coming back in, what that says is they're no longer trying to sell it above. However, they were interested in getting long. So there's a chance, because they got out, they're going to be pissed if markets rally or price rallies, because they were long, they got out, and then it goes. And just ask yourself that question and remember how you feel when you get long. You scratch it, and then it rallies 3 points. You're anxious, you might chase it, you might look to get in as a buyer, but you miss it. So when the longs come in and there's a sample size of them also going away, there's this undercurrent of anxious buyers that wanted to get long, were long, and now they're pissed that had they just stayed in, it would have paid them. So you get that example. Let me rewind it so you can see it again. We're just chopping sideways. You get, boom, this long comes in, boom, these longs come out. It's a sample size of what most of the rest of the market might be doing. Now, we play it. What I'm seeing and what we're seeing in here is that oftentimes that gives the market permission to go up. Second thing is, see these shorts and this red grow? That is a sample size of shorts entering the market. And it immediately goes up after the shorts enter the market. Again, think back on your trading. One of the worst feelings in the world, and I don't mean the worst feeling in the world, but from trading perspective, is to get short, bam, 4 ticks in your face. You get short, you can't even blink your eyes, and you're 3-4 ticks underwater. Had you blinked your eyes and then sold it, you'd have sold it 4 ticks better. So there's a crappy feeling to get short and have it go against you right away. Just again, to fall back to how you feel. It's really important in order to get better at reading the market. You're reading other people. And a way to read other people better is think about how you feel in certain situations, because we're all human. So we're going to feel similarly in similar situations. So the shorts come in, and that's just an upside probability. That's all. What do you want to see for some continuation up? You want to see less green, more red to give us fuel to go up. More shorts, more buyers is what's needed for price to rally. It's not, oh, it'd be nice to have some buyers for price to go up. No, it's essential. It's necessary. It's what makes price go up. Now let's just see, before we get this pop, what just happened. Roll it back. You got this red to create this pop in here. We play it. You had a long come in and go away around 97 even, and then these short, boom, another short that came in. A lot of shorts that came in. Again, this is a sample size of what people might be doing. And you know that at the top of a range, you always have people saying, hey, top of a range, must be great resistance. Let me get short. Sample size of a lot of shorts at 98.5 and nothing but heat. And then the chase is on. And it breaks out the other way. Rotates back down to where they got short, up, and away. And so these are granularity of what you have to look at. These are moments that show the dynamics of why price moves. You have to have an imbalance of buyers and sellers for price to go up or down. Nobody debates that. How do you get there? An imbalance of positions, an imbalance of day traders in those positions, Um, Buying that doesn't get filled makes price go up. Buying that does get filled is interesting, but you have to be paying attention to the relationship between price and that buy order or that buying as if they're dancing together. Who's leading the dance, right? All these things are the right path to get and keep you successful. It doesn't mean everybody's guaranteed success. All I'm telling you is this business isn't easy, but it can be made easier by making sure you're watching the right stuff to give you an edge or advantage and a probability of your prediction so it doesn't seem random. There's a lot of people out there that trade when they make money over the course of a week or two. They feel like they got lucky. They feel like they were good guesses. And in one day, 3 weeks of profit goes away. So you want to pick good locations based on what? Based on longs and shorts getting stuck. There's no coincidence when the market comes back down to where these shorts got stuck, used it as support, and ran up. Not only is this other people's positions, hence OPP, but it's all real time. So many people do all their research in preparing their levels based on stuff that happened overnight or yesterday or last week. And it's like, well, the longer it's been laying there, the more people know about it. The more people know about it, what kind of advantage is it? If everybody knows that there's oil underneath a couple houses, well, then everyone's going to try to buy those houses. You're not going to get them cheap, and there's really no value. So you can't have too many people knowing about the best support level of all time, because that's when it doesn't work. And one of the things I said last week is look for the obvious and do the opposite.